Tuesday? Yeah, it's Tuesday. It's raining here in North Carolina, which is great because we've been on a drought for the last few weeks, if not month plus. But at any rate, again, we find ourselves looking at another breaking point segment, this time led by Sagar. Um, and as always with these segments, what I'm just noticing is a spinning of facts and omitting key detail, which would actually kind of debunk a broader narrative they're trying to push, which is affordability crisis, home ownership costs skyrocket. Um, when you put out videos that leverage averages for this kind of stuff, it's lying. It's lying because when you break it down, looking at a state by state basis, you will find that it is different. But I'll play the opening kind of monologue here from Sagar, the first 2 minutes. And then I got another one from Crystal, who's also on this and just, as always, putting out a bunch of BS. But I'll let this play.
Turning now to housing. So this really caught my eye. I wanted to break all these numbers down with all of you guys. Let's put it up here on the screen. The Wall Street Journal did an excellent job here where they collated a bunch of data which shows home ownership costs from 2019 to 2025. So let's go through it. So in terms of the amount of principal costs that people are now paying, from 2019 to 2025, people are now paying about 22% more in their principal payments than they were back in 2019. And remember, this is just 2025 data. It doesn't even include 2026, which has already gone higher. 22% more when it comes to principal. Now let's look at interest. Whenever it comes to interest, people are paying 35% more interest, largely because of the increase in overall interest rates. Now, all of that makes sense, and it's still not that crazy. Property taxes have gone up by 31%. Makes sense whenever you factor in the principal payment and some increase overall in city services. But this is where things start to become actually insane. Insurance, home insurance costs up 72% from 2019 to 2025. Home maintenance is up by 85%. And then the worst number of them all, emergency repairs up 175%. So they say that a home buyer in 2019 could expect to spend about $20,000 a year on basic home ownership expenses. By 2025, that annual bill is now $28,500, which has massively outstripped overall inflation, which is pegged at 26%. During that same time period, just from the Consumer Price Index. By 2025, homeowners who wish that they could sell and move elsewhere are also staying put, turned off by the cost of purchasing today. This is one of the foremost problems in the so-called affordability trap. What we also see here is that sales of previously owned homes have held around 4 million a year since 2023, which is the lowest level in decades, down from the pre-pandemic norm of between 5 million and 1.5 million a year. So if you do
So I'll just stop there. I put together a little something to cover this as well as some additional context. But essentially, we've all heard the headlines. Homeownership costs are skyrocketing. Principal is up 22%, interest is up 35%, property taxes are up 31%, insurance a whopping 72%. Maintenance 85%, and emergency repairs up 175% since 2019. The average annual bill jumped from about 20,000 to 28,000, way above inflation. But here's the thing: national averages hide the real story. Some states are getting crushed way harder than others. Today, I kind of want to break down by state, or break down state by state. So you know exactly where the pain is hitting the hardest, whether you're thinking of buying, selling, or just trying to understand why everything feels so broken. This is for you. Let's dive in. First up, homeowners insurance has been one of the biggest drivers of the crisis lately. Nationally up massively, but let's look at the map. I've got a map here. Let's just take a look. This is homeowners insurance rates on the average of what premiums are. The highest absolute costs are Florida, Louisiana, Oklahoma, Texas, Nebraska, Kansas, and Arkansas, often 4,000 to 7,000 per year for standard policy. But the fastest growing pain, states like Colorado more than doubled to 101% up. Iowa 96%. Minnesota up 88%, Utah, Nebraska, Arizona, and Illinois. Hailstorms in the plains, hurricanes along the Gulf, and wildfires out west, plus reinsurance costs skyrocketing everywhere. Insurers are pulling out of places like California and Florida because the risk to insure is too high in these areas. And this is almost a direct correlation to policy in these areas. Florida has hurricanes, Texas has hurricanes, Louisiana, Mississippi, Alabama, hurricanes. They seem to manage it very well. Their insurance rates, by the way, aren't nearly as bad as, say, California. If you're in wildfire area, which wildfires are taking, I mean, they're burning down more and more territory, but that's because policy is driving the outcomes, which is creating a higher impact on those wildfires. If California could get their wildfires under control, or Colorado or some other places, then the insurers that are insuring those places would drop rates because the risk wouldn't be as high. I'm just going to put that out there. If you live in these states, your hidden ownership costs are exploding faster than the national numbers suggest. Next are property taxes. These aren't uniform either. And from a property tax perspective, let's take a look here. The highest effective rates hit New Jersey around 2.2%, Illinois over 2%, Connecticut, Nebraska, and Texas. High income states like California, New York, and New Jersey rack up huge absolute bills, even with some caps or moderate rates. Increases often come from rising home values, triggering reassessments. If your local government spending is high or values boomed, you're feeling it hardest. So one of the ways in which states like New York and New Jersey are trying to fill budget deficits the same way for California is to increase taxes. And one of those is increasing the property tax rates. They might say, oh, we just want to increase it by 0.1%. Well, when you're the highest in the nation, 0.1% on $1 million is a lot of money. Property costs within the cities in those states is crazy high. And so you're paying a significant amount in property taxes. I mean, it's absolutely ridiculous. And I'll get into why I think Texas, Florida, and some of these other places, while they might seem high up front, and especially if you look at these particular costs, there are other lacking costs that net that out to a much lower rate. But in regards to maintenance, repairs, and homeowners associations, maintenance and emergency repairs up 85% and 175% nationally. These spike in weather-prone areas, the hail belt, which is Texas, Oklahoma, Kansas, Nebraska, Colorado, and Iowa, the hurricane zones, Florida, and the Gulf Coast, and wildfire states, California and Oregon. High cost of living areas like California and the Northeast also see pricier labor. Again, this goes back to policy, setting exorbitantly high minimum wage rates versus doing or having it at the minimum or the national average is driving up these costs. Private equity, buying up local repair shops isn't helping. They're squeezing profits where people have no choice but to pay. Homeowner association fees are rising too. National median around $135 a month, but much higher in Florida, Nevada, Arizona, California, and the big city condo markets like New York and Miami. Um, New York and Miami is more due to the distributed costs of taxes, because like in places like New York City, you don't necessarily pay a property tax when you're in an apartment. It's just rolled into your overall fees. Some you might pay a property tax, um, and then you might find lower condo fees or lower fees. But like if you live in a condop, or there's another one that I'm forgetting, I'm blanking on right now. Your maintenance fees are directly tied to the taxes for that building. And so they're divided over the number of units and by the space that those units actually consume. So if you have the biggest unit, you're paying the most in maintenance fees, which is directly correlated to the property taxes there. This is why, like, if you look at, I lived in the Upper East Side, you can actually buy apartments or condos or condops, um, in the Upper East Side for $200,000, $300,000. But then you look at the maintenance fees and they're like $12,000 a month. It's insane. It's absolutely insane. And those fees are directly correlated to the property taxes that are assessed on that building, divided over the units based on the square footage of each unit. Um, Again, as property values go up, those assessments go up, those costs then go down to the people that are in those buildings. Same thing for these high cost areas, New Jersey, New York, Illinois to a certain extent. Like, their governments are running low on money because people are fleeing those states for places like Texas and Florida and North Carolina, where I live, Georgia, Arizona, in some cases, New Mexico. But they're fleeing. So the way that these states are, again, recouping that loss is by increasing property taxes or doing a reassessment based on the new assessed value of said property, which then gets more money via property taxes. Um, Home prices drive the principal and interest side. The most expensive markets, as I mentioned earlier, California, the mid-tier home is around $750,000. Hawaii, Washington, Massachusetts, New York, Colorado, Oregon, and New Jersey. This creates the affordability trap. Um, People with low rate mortgages from years ago refuse to sell and buy at today's prices, plus the rates. Existing home sales are stuck at decade low levels nationally. The lock in effect is brutal everywhere, but especially punishing in these high price states. Um, for first time buyers and older, or for first time buyers, sorry, are older in their mid 30s to 40s, delaying wealth building for millions. So I pulled up my mortgage. And I'll show it to you in a minute, but this is actually true. So right now the interest rates are around like 6.5. Um, and it's interesting, the Washington Post and Sager decided to start at 2019 because that is when the rates were the lowest. So you're getting mortgages around like 1.9 to 2% or 2.35, somewhere around there. Mortgage rates currently sit around 7.5. I bought my house at 7.35. It was 2 years ago. Um, and so all of these people that bought houses at let's just say 2% or 2.3% have no interest in selling the house that they have a low mortgage payment on right now and are sitting at around 2%, to then get a mortgage at 6.5% and then also spend more simultaneously for the house. A lot of this inaffordability right now is being driven by supply and demand. So if there's not enough supply of new housing or existing housing coming onto the market, then the houses within the area are going to start to go up if demand in those particular areas is still high. If you're in an area where you have um, low demand, and you're asking for high prices, like say New York, for instance, you're going to start to see those prices come down over time. Or the people can afford to just keep the houses on the market indefinitely or pull it off, and then wait for a time when demand starts to increase and they can put the house back on the market. I live in a high development area. And so what you have are there's a lot of buyers for new home developments like the one that I live in. There's also people that have existing homes that want to sell and move out, and they're competing in the same market. And the incentives to buy new versus buy pre-existing are so much better. And so the people that have pre-existing homes are kind of screwed because the number of homes that are coming on are roughly the same square footage and roughly the same size, and they can't really compete with that. So there's a huge supply, or there's an ever meeting supply, and then the demand is being met by the supply of houses coming on. So if you're trying to ask for more for your house, it's not going to happen. Right now, by the way, if you want to invest in property, and this is not financial advice, this is my personal opinion. Do your own research. Places like North Carolina are the ones that are worth moving to, because it has a vibrant job ecosystem. There's a bunch of tech, especially in the triangle area, the Raleigh Durham kind of corridor. And then there's a whole bunch of new houses coming on. And so similar to the way that Northern Virginia was in the late 80s and into early 90s, North Carolina is that right now, where it's expanding rapidly. And at some point in time, the development will slow, which means that supply will shrink. Demand will still be high for people that want to come into the area, which means that prices are going to go up. At any rate, so in the bigger picture, why it matters. So why does this happen? Climate risks, supply shortages, financialization. These are wealthy investors and private equity buying up assets. Play a role in this. National averages smooth it over. But if you're in Colorado, Florida, California, New Jersey, Texas, it probably feels a little more personal to you, and immediate, in some cases. And I'll get back to Florida and Texas. The states driving the worst averages are a mix of coastal powerhouses with surprising inland spots hit by recent insurance shocks. The bottom line: don't trust the national number alone, or the national numbers. Um, Check your state, check your local market. Um, you know, what do you think? Is your area hardest hit? Do you see these kind of increases in your area? I will say, as someone living in North Carolina, I don't, and I'll tell you why. Um, Let me just pull up my next one here. So, what I find interesting is, so costs are rising in certain places, and certain people are feeling it more. Where they're not feeling it as much, generally speaking, is Texas and Florida. Even though some of the other outstanding costs are going up, Texas and Florida have no income taxes. So you pay nothing out of your own salary. So let's just say you live in New York, where, again, and by the way, these are the 2024 numbers. I'll show you the 2025 numbers, and why North Carolina is a great place to live. But again, if you're paying, like, let's just say, if New York's is 10.9, I lived in New York, my income taxes were 15%. Um, I was in I would say the 150 plus to 200K income territory, which is 15% of my income was going to taxes, because you're taxed at New York State and you're taxed at the city level as well. Um, I moved to North Carolina, where the income taxes are 4.5%. I got a raise just by moving here. So all of the money that I wasn't paying in taxes to New York is now just income that I can do other things with. If you're moving from New York or California, California is 13.3, New York 10.9, let's just say 11%, round up, or New Jersey at 10.75, and you're moving to Florida or Texas, your income is going up by that same denomination. Your income is going up by 11% or 13.3 or 10.75. And so that's significant. Those are thousands of dollars, in some cases, tens of thousands of dollars, depending on your income. And so these other costs that Sauger is bringing up and focusing in on are costs that don't necessarily matter to you. Again, if you're in a high tax state already and you're seeing your costs go up, you're screwed. You're absolutely screwed. But by the way, let's take a look at this. So in 2024, North Carolina was 4.5. Hey, guess what? Our income taxes just went down 4.25. So again, down 0.25%, but that matters. And you'll find this in many red states where income taxes are going down. Like, let's say Mississippi, 4.7, today 4.4. So while some of these costs are going up in these areas, income taxes, the taxes that you get hit directly with, are going down. So it's essentially netting out for the people that were already living in those states. And for the people that are moving in, they're seeing significant cost reductions overall. And when you see these additional costs, you're like, oh, that's actually not too bad. Like, I can deal with that. And I'll give you an example of my mortgage, right? Blacked out all the important stuff on here. Feel free to try to find me if you ever so want to. But again, my mortgage right now is at 7.375. I am going to be refinancing. I'm actually just waiting for rates to go lower, which may not happen for a time period. So I can just continue to pay more on my mortgage if I want to go to principal. Or I can refinance, save $300 a month, and bring my mortgage down to 6% or 6.25, I think, where it's sitting right now. But again, I pay $5,100 a month, which to a lot of people may be a lot. Part of that's due to a tax reassessment, and the escrow that was being pulled for my taxes. They actually gave me a check in the mail because they were like, oh, we overestimated your taxes. Well, the first year I bought a new house, they assessed it based on the land value, not the house. And so the next year they did a reassessment. It was actually based on the house, and my taxes went up. But Rocket assumed that it was lower and just cut me a check for like $4,000, which was great. But then I had to pay that back. So that's what that is right there. So my mortgage is actually around like 48. I think it's like 48 and some change. But you can see insurance costs $149, taxes $497. Like, we're not talking about huge amounts here. My HOA fee is $106 a month. It's not really that big of a deal. Again, I bought a house for $750,000. I put 20% down because, as I mentioned in a previous video, both my girlfriend and I made investments, and we used those investments to put 20% down on the house. So now we have a whole bunch of equity in the house, and we're not really stressing. So even when we go refinance, we can actually pull out some equity and do other things with it. But at any rate, I thought that was interesting. Again, the overall thing that I want people to understand here is that Sauger and Crystal run fear mongering, which is super annoying. And you can't just look at averages on this stuff from a nationwide perspective. You got to look at the individual states because they tell a completely different story. And while you can just go, oh my God, costs are increasing everywhere, there's a lot of factors that specific states have in play that aren't in play in other states. And there's also tax implications that other states have that certain states don't. And so to just blanketly say like affordability crisis and do this entire fear mongering episode, like it's just ridiculous. It doesn't look at the whole picture. But I'll leave it on this one because this is a framing that I just find super, super annoying.
One of the things we focused on a lot is the electricity costs, which have skyrocketed, which is also documented in that Wall Street Journal piece we were talking about. And this again goes back to like the oligarchs and their demands. That is the primary reason why electricity costs are going up and up and up. And I took notice of this recent development with federal energy regulators. Here's the headline here. Federal regulators order grid operators to speed power to energy-hungry AI data centers.
So I'm just going to pause it there. I will say this. The AI data centers are taking up too much power story is just, it's annoying, honestly. This is a policy-driven outcome. The US has made it difficult, and I mentioned this in other videos. The US has made it difficult via policy to build new energy infrastructure. This is whether it is a nat gas power plant, a clean coal power plant, a nuclear energy plant. They've made it almost impossible to do this. And so they've been pushing these stupid solar incentives and wind farms. If it's not windy, they're not producing energy. If it's not sunny outside, like today, for instance, because it is raining here tremendously, not a lot of energy is produced. And again, if you look at countries like China, for instance, the number of natural gas power plants that they're spinning up is ridiculous. And it's dwarfing US energy production. And regardless of whether AI was here or not, data centers are growing exponentially because more and more of our daily lives are going to storage within data centers. The cloud isn't somewhere in the sky. These are physical buildings where all this data has to be stored. So whether you have an iPhone, you have a Samsung, you're leveraging Microsoft 365 that backs up everything to the cloud, or another solution, or your corporate office, everything is moving to the cloud. Salesforce is a perfect example of this. As users roll into Salesforce needs more compute infrastructure in order to support that. That computer infrastructure has to come from somewhere. And so the longer that we delay building new energy infrastructure, energy costs are going to go up. Fortunately, here in North Carolina, we have a nuclear power plant, which is not too far from here. And the idea would be, hey, we can just open up another portion of the nuclear power plant. We've already got the infrastructure built and everything else. Like, let's do that. Even that is going to be difficult. Getting a new nuclear power plant is difficult. But I get tired of these arguments, this total doomerism over AI data centers and whatnot. We can solve these problems easily, but it is NIMBYism. People simultaneously will say they don't want their energy costs to increase, while simultaneously saying they don't want development of new energy infrastructure. Like, these things do not compute. So at any rate, I think I may actually start lobbying for an expansion of the nuclear power plant here, or at least a nat gas facility. But at any rate, tell me what you think in the comments section below. Do you agree with all this doomerism coming out of places like Breaking Points, Saga, and Crystal? Or do you look at it more from the state level and understand there are intrinsic differences between states, and there are certain states, specifically blue ones, that are driving up the overall cost, then it's almost directly due to policy? Let me know what you think in the comment section below. And as always, keep believing that the best is still ahead for America. Peace out.